the upper limit on, let's say, I think if I did the math right, here's the math. If I did the math right, that should be, I think. Question there? You can take a screenshot of that. Oops. Okay, if you've already turned in the chapter, I mean the monitoring unit sampling, if you already turned it in and you didn't have that one right, don't worry about it. You get 100%, but you may want to make a note on it if it was anything. All right, what are we doing next? Hold on. Oh, conceivable multiple choice. Okay, so this is for the extra credit points. I think there's 6 of them. Yeah. Okay, so so correct, we get 3 correct. Plus 2. 4 correct. 3. 5 correct. 4. 6 correct. Plus 5. Okay, so I'm gonna go ahead and start the poll. Just sorry about that. That obviously was not starting the poll. All right, so 1 through 6, and whatever you put in for 7, 8, 9 doesn't really matter. And 10.
Professor, can you scroll up or to the next question, number 3?
Yeah, and I did send these out, I think. Should have. They won't be in Blackboard though.
Are we just doing up to 5 or are we doing the whole 10?
No, 6.
Up to 6. Okay. Professor, I'm trying to submit it, but it won't allow me.
The poll?
Yeah.
You have to put something in for 7
Oh,
through 10. You put anything in, it doesn't really matter. But we're not going to count it. Yeah, it is a quirk of the polls. Is everyone still working on the multiple choice?
I'm finished.
I'm done here.
I'm finishing up.
Professor, can you go to number 4?
Yep.
And can I see 1 if you don't mind?
And these are in your email. They should be in email. I think I sent them. Like, maybe I did.
If, Professor, if you can go to 6 and 7, and then I'll be done. Oh, it's just 6.
6.
Then, okay, just 6 then. All right.
Yeah, then put anything in 7 through 10. Yeah, I think everybody's in. Check and make sure. Yes. And poll share results. Okay. Some of these are kind of tricky. These are all real CPA questions. Number 1. Which the following is not considered an alternate procedure? Unfortunately, it's A. I shouldn't say, no, I'm sorry, take that off. B, you're right. It's A is not very good evidence, but the inventory cost, you're absolutely right, is B. Very good. All right, adequacy of love for doubtful accounts is A. What do you have? B. For number 3, positive accounts are for large balances. Positive accounts take more time and more expensive to do. And you have to get them all back. So they're better evidence. The negative form are for small balances that even if you don't get them back, that they are Usually they're not material because they're small balances. Number 4 is the trickiest one, I think. Which the following is the best argument against the use of negative confirmations, and it's D. That you really should not make any inference about the ones that you didn't reply. It could be that they didn't receive them, it was sent to the wrong address. It could be they didn't care, they didn't mark them, it could be whatever, but the non-replies really don't have any bearing on your evidence that you're getting from it. The only evidence you get from it, though, is seeing what the problems might be with the inventory itself. So if a lot of people say, oh, the price changed when I got the invoice, well, then you might, there might be a problem with the pricing. And actually, C is kind of a funny one because one of the ways, that's not me. That is me. It's not the live me. One of the ways that they get people to respond to them is by saying that, if you don't respond, we'll assume that this is correct. So they actually you put in there almost like that they want you to act as if this is a, some kind of a legal thing or something like that, but just to get a response out of them. But yeah, so they just to try to get more people to respond to it. Okay, 5. Tracing recorded sales transaction in the sales journal to shipping documents provides evidence of good. That they occurred. You're going from the sales journal, so what they say that they sold, and you're saying that you're looking at the shipping documents to see if those shipping documents back up that there was actually a sale made. If you went from the other direction, you went from the shipping documents to the sales, it would have been C. All right. 6 is a little bit tricky. Sam's all the shipping reports FOB shipping point would be recorded in December as credit sales. Yeah, so these are ones that were shipped in January. Oh, you guys like that. Never mind. Well, very good. Yeah, it overstates the accounts receivable. It'll overstate accounts receivable. It'll overstate sales. It will understate inventory. Okay. Let me stop sharing. Okay. Next thing on the agenda. Let me save this. We'll start the chapter 12 handout. We'll see how far we get, and then we're going to have the sampling overview. So we'll start on chapter 12 handout. Chapter 12 and chapter 13 will be tested together. Just so you know, chapter 13 is on property, plant, and equipment, which kind of, I don't know if you're gonna call it funny or whatever, but that a lot of it goes by, they're sort of like inventory, you take an inventory of property, plant, and equipment. It won't be inventory you're ready to sell, but it'll be, an inventory of property, plant, and equipment. So they kind of are similar in many ways, because you're actually looking for assets, physical assets, and verifying that they are there. So chapter 12 and chapter 13 will be tested together. Okay, well, let's jump into chapter 12. Oops. This is chapter 12. Okay. Inventory. I think I told you guys this before, maybe I didn't, but when I was in auditing, I think like the first few audits that I was on, I was put on with inventory. Inventory is for a lot of places is just huge, and it takes a lot of times it takes a lot of people. It's very common to start people out in inventory because it's massive and it is fluid. You got stuff being purchased every day. You got stuff being sold every day. So you have stuff coming in, stuff going out, getting the invoicing, getting the billing, getting the accounts receivable, the accounts payable, all that stuff. It's all related to the inventory. Plus inventory is an asset, so you have to make sure that the assets on the books and, the accounts receivable are obviously assets, those go along with it. So, inventory is really kind of a pain, and it's kind of a pain just because there are some, and then on top of it, you got the complications of returned items that were shipped that were broken, stuff that was theft, things that broke in the store, things you got all these other things that go along with inventory. Inventory can be really a headache. Anyway, long story short, so I think I was put on inventory the first few audits I did, and it kind of stuck. I kind of became inventory guy. Who knows why? I have no special interest in inventory. But anyway, that was kind of like my kind of specialized field. So like every audit, and after a while, I even went away to they had a special inventory system when I was at Navistar that I actually went to conferences on it. It was kind of interesting. And the company that I was with, Navistar, we all stuck out because sometimes they'll modify the software, and I think we had the most modifications. The company with the second most modifications had 10 modifications to the software. We had over 200. So what we were looking at was kind of not really the same software as what other people had, but anyway. All right, so getting understanding of inventory. Now, inventory, when it comes to taking inventory, it usually comes out into two different forms. There's a periodic one, usually done at year end. And there's perpetual inventory, which is done continuously. So periodic inventory done at the end of the period. It can be done more than one time in a year. Usually they do it once a year, but it can be done more than once. And so done at the end of the period. Generally, oh, that's not generally. Generally, inventory taken at year end is the best evidence. It's the most current. So periodic inventory is at the end of the period, you take the inventory. Perpetual inventory is done by many stores, larger stores. For many larger stores, for someone like Walmart to do a periodic inventory all their stores at year end, it would be nearly impossible. You can't get that many people. So what they do is a lot of times they will have inventory done throughout the entire year. And generally they count in all the inventory in the stores at a given time at least once throughout the year. So everything gets inventoried, it just gets inventoried at different times during the year. And if you ever go into a late night Walmart, one of those that's open to midnight or whatever, or 24 hours or whatever, you'll see it, you go out there at 1 a.m, you'll see people taking inventory in different aisles and things like that. Or you'll see aisles that are like cordoned off, like don't come in here, and they'll have tags and stuff on it that are going to be inventoried. And that's a periodic inventory thing. Those people would be there at that time no matter what. Now, if you're an auditor and you're auditing Walmart, you're going to go observe those inventories. Maybe 2 a.m. on April 7th or something. You'll be observing the taking of inventory in the store. So a lot of times, especially larger stores will have inventory that's done throughout the year. It'll be a perpetual inventory, and they'll keep their records as a perpetual inventory. Okay, so perpetual inventory. So, oh, often the inventory, so often the physical inventory. So let me kind of summarize this. It is possible that perpetual inventory still take a year-end inventory. But oftentimes what they'll do is they'll have test counts during the year. And so the physical inventory will be counted again perpetually throughout the year. So before year end, interim dates, they will have inventory counts. So they'll do an inventory count of whatever, blue jeans. They'll have an inventory count of blue jeans, and they'll see, they'll update their records if they have more blue jeans than they thought or less or whatever. And they'll do that perpetually. So a lot of times perpetual inventory, and again, a lot of places have perpetual inventory, and you can do a year-end inventory. For periodic, you must do a year-end inventory. For perpetual, or you won't know what your sales are. For perpetual, a lot of times they will do the inventory throughout the year, what they call interim dates between January 1st and December 31st or whatever. And they'll immediately update their records based on those interim counts. And again, the larger stores will all do this. Now, you can always insist on a periodic inventory. So if you're doing someplace that is perpetual and they have inventory counts at interim dates, they're perpetually doing their inventory counts. You can insist, if you think that their controls are not very good, you can insist on, let me put that in here. Controls are inadequate, to say the inventory controls. The auditor may insist on a year-end inventory. I'm gonna put them as separate. So if you're looking at the inventory and you're just not getting the warm fuzzies that they're making the corrections they need to make. You can insist on a year-end inventory count. Okay. So these are two types of inventory systems, and a lot of times the physical inventories will be taken, well, the physical inventory has to be taken for the periodic. The perpetual one, the inventory can be taken throughout the year. A lot of time, they can also take it one at year end though. Many stores don't do a year-end inventory though. They do a periodic inventory as well, physical inventory as well as doing it on the books. And in a perpetual inventory, virtually every place is going to have that. If you go into a grocery store and you buy milk, when they scan that milk through, it says, okay, you no longer have 438 milk, you have 437. And so they continually update the inventory. So perpetual systems are used all over the place. And a lot of times, especially for the larger stores, they're going to also do the inventories on the perpetual basis. Okay. Obtain a listing of inventory and reconcile it to ledgers. Okay, so this is the ledgers. It could be special ledgers. It could be you could have an inventory ledger. Could also be general ledger. One thing about inventory, well, two things. There could be two problems with inventory. The first one is the count. And the second one is the price. So when we look at inventory, we do actually, we separate these out usually. There's a couple situations where they kind of overlap, but we do count and price. So the two problems with inventory, it could be a problem with the count. They say they have more or less than they really have. It could also be a problem with the price. The price is wrong for the inventory. We should say cost, maybe is a better way to put it. So the count and the cost of the inventory. And so this will, when you take a physical inventory, you're generally looking at the count, but there are some times you look at the cost of it. Okay, client's planning of physical inventory, selecting the best dates. Year end. Oops. Year end is usually the most desirable, obviously. It's the most recent. If inventory controls are adequate. And we might be taking at different times. So if the controls are adequate, then you possibly you can do it at different times. So if you can back into all the pluses and minuses of the inventory, you can do it at different times. When I was at US Steel, we did the there's two parts to steel. There's making steel, and then there's what they call rolling steel. So if you make steel, it comes out in big, huge slabs that are like 40,000 pounds. And they're like this thick, and they're 20 feet long, and it's just steel. It's a big old hunk of steel. And they're not worth that much because it's just a big hunk of steel. But then they also do what they call rolling, where they actually squeeze the steel to roll it, and it becomes a sheet, and then they can make cars out of it, and washing machines, and all kinds of stuff. So there's those two different parts. When I was at US Steel, we did those inventories separate. We did the steel side on one day, and then the next day we did the what they call rolled steel, which was a much higher dollar inventory because it was changed into something that people could use. Okay. And we did this, suspended the production. Possible production should be suspended in manufacturing facilities. And sometimes you can do this, sometimes you can't. At US Steel, so suspending it. At US Steel, making the steel, we couldn't suspend the production. The way steel furnaces work is that they have to be fired up all the time. You can't shut them down. If you shut them down, you're out tens of millions of dollars restarting them. So they don't shut down but now the good thing for us was that the steel making side was not the most profit. It was not the highest dollar amount of stuff anyways, but we couldn't shut down the steel making part of it when we did our inventory. Again, we could always just count those things that came into existence and all that stuff. And when I was at Navistar makes trucks, and that they would usually close down the facility for the holidays anyways. So really at year end there was nothing being produced anyway. So that was really easy to do because a lot of times, and this is true for a lot of manufacturing companies like auto manufacturing, heavy manufacturing, when they make design changes, a lot of times they'll do it the last week or 2 weeks of the year. And they'll change over all the equipment, they'll change all the, all the stuff that they need to do, and then they'll start up with the new year production. That's fairly common. So for like when we did the inventory for in Navistar for the truck stuff, it was already shut down. We didn't have to do anything unusual. Okay, now this is where saying obsolete and defective goods. What time is it? Oh, we're getting there. All right. I was thinking defective goods need to be segregated from the rest of the inventory. While the count. Well, the count of these goods may not be in question, the cost of the goods. So it's fine, again, a count of the obsolete inventory isn't gonna be the problem, it's going to be the cost. What do you put that on the books for? You have something that is obsolete. So this is one of those things in inventory where you're taking a physical inventory, generally you look at the count, but cost may come into play for obsolete and defective inventory. All right. Inventory takes you. Have any of you ever done inventory? Has anyone ever taken inventory at a place? You don't have tags or count sheets?
I have
Yeah, have you? Did you guys use tags or the count sheets or? Sometimes you.
count sheets.
Okay, yeah. So here's what happens a lot of times. And if you see them taking inventory to the store, sometimes they'll have count sheets. So they'll have a rack of coats, and they'll have a count sheet for that rack of coats. And you go in and you write down how many there are, what the SKU number is. There'll be SKU numbers for the different sizes and all that kind of stuff. And on that count sheet, you'll take that count sheet and do all the write down everything that's on there and turn that in. Now those count sheets are going to be numbered. They're going to be serially numbered because they're going to put out, if they put out 422 of them, they have to get back 422 of them. And they'll usually have some kind of a chart that'll show where the numbers are, whether in the store they're, here, these are numbers, count sheets 38 through 52 or whatever. And they all have to be accounted for. Sometimes they'll do the same thing, but with tags. So they'll tag something as, okay, this coat rack is tag number 47. And so you'll just have a count sheet, and on that count sheet, you write down, tag 47, and then take the inventory for that. And usually you take the tag off of that. Sometimes they use two tags, a lot of times they'll just use one. You take the tag off and staple it on the sheet, and that way, they know which this is for. Okay, so they'll have count sheets or tags that go onto count sheets for everything. So so you'll go through the store and make sure that that everything has either a count sheet or a tag. So inventory tags or count sheet should be attached to all locations. So they'd be serially numbered, and you go through and make sure that everything on there has a we'll talk more about this later, but You guys can't see what I'm doing. Idiot.
Yeah.
I'm sorry. All right, sorry about that. The standing code control of the process through inventory tag sheets. Serial number tags are inventory count sheets to be attached to all inventory items and or locations. Okay, so so they're serially numbered. You account because you're gonna have to account for all of them. And everything, so before they take the inventory, you're gonna walk through and make sure that everything is supposed to be inventoried is either has a tag or a count sheet on it. And basically, if you're wondering why we do it, we'll talk about more about this maybe next class. You want to make sure that everything is counted, but that it's only counted once. So at the end of the inventory, you're going to walk around and see if there's any tags or count sheets that are still attached to inventory. And see if that, if they have those things been inventoried or not. So you're going to walk around the store and make sure that, see if the tags have fallen on the floor or something like that. See if they're all, but also, once those tags or inventory sheets are gone, that it won't be inventoried again. So it's to make sure that everything's counted and it's only counted once. So we'll talk more about that. Okay. Proper cost sale and purchase transaction range for the services of engineers and other specialists to determine the quantity and quality of certain goods and materials. Okay, so I'm just going to take the purchases and the sales. The sales, oops. Sales cutoff is usually done through the shipping department. And a lot of times you'll be looking for bills of lading. Did they actually sell it? So is there a bill of lading there? Purchase cutoff. Oops. Is done in the receiving department. And you'll have receiving reports. One of the tests you do in the receiving department is to take a look and see if there is anything that has been received that there's no receiving report for. If they have something that's sitting there that hasn't been, that is there at year end, but that there hasn't been a receiving report made. So sometimes you just take a walk through the receiving department and see if there's anything just sitting on the dock that came in that was not matched up yet. Let's stop here. Okay, let's say be back at, let me pull up the next thing we're gonna do. Next thing we're gonna do is start on the sampling overview. Back at, what's I'm gonna do, let's say 712. And we'll start on the sampling overview. Sampling overview is the last of the new stuff for sampling we'll cover. All right. I was gonna tell you about this, this first one here. Obtain a listing inventory and reconcile it to the ledger, so get a listing of inventory to be counted and compared to the ledgers. I had a funny. Audit one time that the beginning inventory didn't match up with the ending inventory from the previous year. You know, usually the ending inventory on December 31st becomes the beginning inventory on January 1st. And it didn't match up. And it was off by not a lot, a little bit, nothing material or anything like that, but it was off. And I was an internal auditor. So this, you know, external auditors wouldn't have batted an eye. But as internal auditor, I was kind of curious, why is the inventory different from December 31st at midnight to, you know, midnight plus one, and going into January for why is it different? And so I went to accounting and I said, you know, why isn't this? And the guy at accounting knew exactly what I was talking about. He said, well, you know what? You got to talk to IT. This is, you know, IT guy. They sent me this IT guy. And I go to this IT guy and he goes, yeah, you got to talk to, and he sent me to this purchasing guy. This purchasing guy went to negotiate, you know, purchasing stuff for the place. And I don't know how he did it or why or what, but he renegotiated for sales that were already done. So he negotiated backwards the prices, you know, for like, you know, well, we bought these, you know, 4 months ago or whatever, and we don't, we should be paying this, we should be paying something else, and whatever you got, you know, some of the stuff was reduced, some of the stuff was marked up. It was just there was probably like 5 or 6 accounts that did this. So literally, you know, and the difference was like, I don't know, a few $100s or something. And he kept telling them, you know, look, you got to change that. The cost of these, you know, back in October, you know, this should be changed to this new price I negotiated the next year. And harangued him enough that finally the accounting guy and the IT guy, oh, fine, you know, we'll change them. And that's what happened. And I said, well, okay, you know, I mean, I see you negotiated this. Why didn't you have him, you know, just cut a check or give you a credit or whatever? He said, well, that's what they kept saying. I was like, yeah, they kept saying that because that's the way you do this. You don't go back in time and, you know, change that. But anyway, it was kind of a weird thing because usually it's, you know, it's the ending inventory is the beginning and that's just it. But it just bugged me that it wasn't. All right. And they literally had to go back and like code it to be, you know, to make this happen. All right, let me see. Okay, sampling overview. So this is it's sampling overview and tested controls. And these are just kind of some of the odds and ends for sampling, but the tested controls are actually on the CPA exam, they're tested quite a bit. So I put this kind of together in a kind of a, oh, I don't know, kind of a wrap up kind of a way. Okay, random samples. I think we talked about this. Generally you want to have a random sample because it represents it's the most accurate representation of the sample. Oops. Okay. What am I doing here? The most, a random sample is desired because it's the most accurate representation of the population as a whole. Random samples are without bias. Or she should be without bias. So one of the reasons why we try to get a random sample, and one of the reasons why getting a random sample is so important is that it's the best representation of it's without bias. It was the best representation of the population as a whole, which is what we want. And this is something that is, as auditors, as financial auditors, I should say, as auditor of financial statements, you're not necessarily looking for specific errors or frauds. You're looking for material misstatements. And this is kind of an important distinction between, say, the external auditors, the auditors of financial statements, and internal auditors that are looking for, how can we make improvements? You're not necessarily looking to make improvements. You're looking, and you're not looking for specific errors or fraud. It isn't like, hey, we're gonna try to find, all the fraud or all the errors here. You're looking to see if they are. You're looking for material misstatements. And so this is why we're looking for it without bias. We're not trying to find problems necessarily. We're trying to see if the financial statements are materially misstated. And if they are not materially misstated, if there's errors and fraud, it doesn't really matter too much to us. You think about like a large company, there's going to be errors, there's going to be fraud. They just are. It would be very unusual to have a place like Walmart not have errors and fraud. Huge company, millions of people probably working there. It would have to happen, but you're not necessarily looking for those things. Okay, systematic selection. This is probably the second best. Oops, spell second. Right. Let me give you an example. Here's an example of it. It's probably easier than kind of going through a definition-y thing. For instance, every 10th item is chosen for the sample. And you could have a random start to it or whatever, but basically, you're picking item 10, 20, 30. Again, you could have a random start. Which would mean you'd have item, whatever, 3, 13, 23, etc. So this is what a systematic selection kind of looks like. It's when you pick every, 10th item, 12th item, 20th item, whatever it is. And while it may not have a sort of it may not have a sinister bias to it, it is possible that, as you skip, for instance, let's say that you skip 4 through 12, it could be the invoices with, number 11 or whatever are the ones with the problem. And if you're doing this, you'll never find them. So there is somewhat of a bias against the numbers that are not picked. Um, let's see, we'll put this is the best here. Okay. Haphazard selection. Let me give you an example of this. I did one of these. um, a blindfolded auditor. Picks folders. Oops. What of a file cabinet? So you just grab things. Now, there's a problem with this one, and that is, this is why you generally don't use this one in an audit. These two you can use in an audit because they're repeatable with the same results. They go repeatable. Now, it's not repeatable. If you blindfold a different auditor, they're probably not going to pick the same ones. If you do the random sample, you can do a random sample, you either use the table or you could have a computer generate it, and the same people would pick the same things because it's a random sample, but they're the same ones. Same with this down here. If you do a random start of say 3, pick every 10th one, everyone will pick the same items, 3, 13, whatever. Haphazard, if you blindfold a second auditor, they're probably not going to pick the same ones. So this is not repeatable, and this is really not not useful for financial audits. Has it never been done? It probably has, but generally you're not going to do that because it's not repeatable. Everything you do in audit needs to be repeatable with the same results. Okay, block selection. This is probably the worst. The old saying, block selection is for blockheads. Example. The entire month of October. is used. Entire month of October, this is the block. Is usually determine the validity of sales for the year. Obviously, October is not, you know, if something happened in December or January, whatever, it would not be able to be tested. This is, again, block selection is sort of like for blockheads. This is repeatable, but it's just a bad way to do it. So it is repeatable. Anyone could say, okay, we're taking all of October sales and assuming those are for the entire year. Okay. Haphazard selection. I actually did this one time. It was a very weird situation. I don't know if somebody may have already heard this one, but I was at US Steel. And US Steel had these huge buildings because they used to have hundreds, if not thousands, of people making invoices and all. You know, before computers and all that, they had to do it by hand. And so you had these rooms filled with people with adding machines and with, you know, making out invoices and all that kind of stuff. Well, those people are gone, so now they have these huge buildings, and you know, fighting space for the Gary Steelworks plant. You had your choice of 10 big, huge, empty buildings. You could set up shop anywhere. Anyway, they were doing this billing in one of these huge buildings, and so I go into the billing department and everyone's there, and I finally get to these kind of specialized invoicing things, and they said, "Oh, well, yeah, that's done down the hall." So I go down the hall, and this hall is really long. I mean, it's hundreds of feet or whatever, and I can hear people talking. And I get in there, and there's one person. It's this woman who's in there, and she's talking to herself. And it was really weird. And then, I was just right out of college. I had, and apparently she was a schizophrenic. And so I'd ask her a question, and she'd kind of look at me, and sometimes she'd say stuff, and I, didn't. And so I say, well, these are what I'm trying to find. I'm trying to find these files. And she'd just kind of look at me, and she'd say something that I wouldn't even, half the time I didn't know what she was saying, and half the time it had nothing to do with it. So after about literally like 15 minutes of this, which seemed like forever, I walked back down the other, like, well, what's going on? And they said, yeah, she's schizophrenic. She's super smart, but she's a schizophrenic, and she's not taking her medication. And it's a union thing. They can't make her take her medication. So I go back down there, and so I go, okay, well, I'm just going to start going through these files. They're there, and I just kind of told her, look, I'm going to look through these files. She had all these boxes, and they're on the shelves. I couldn't make heads or tails out of any. I could not figure out how these things were filed or where they were. I got this list of things I'm looking for, and I mean, there's nothing. I can't. Yeah, and I'm kind of asking her, and kind of showing it to her, and then she'll look at it, and she'll look at me, and that was it. It was okay, fine, So I got a hold of my supervisor, and I was like, "What do I do? I don't know what to do here. I can't find anything. I don't know what the system is here. There probably is a system, but I don't know what it is, and And he said, well, okay, do a haphazard selection. He said, go and take, pull out, 10 boxes, take out 2 or 3 folders from each of them. Write them down, and go through those as if those were the ones you picked. So that's what I did, the haphazard one. The kicker, every single one of them was absolutely right. There wasn't a problem at all with any of them. They were all meticulously costed out, and they were kind of like the sort of like the hardest invoices to do. They had a bunch of partial stuff that you had to kind of add together and all that. But anyway, that was a haphazard one, and again, it was just out of I would still be there probably if I if I didn't do haphazard, but generally you don't want to do those. But they were really out of the way, and and I guess that they were the one was going to retire in about a year, so they were kind of waiting for her to retire or whatever. But it was kind of wild, and I remember like asking, well, someone should help her. Just can she get home? Oh yeah, they said she's super smart. It's just okay. So anyway, that was a haphazard selection, and that was the only time I ever did that. No, there are times that I didn't do that. I did ones that weren't any of these. And that's because I was an internal auditor. We were actually looking for problems. Unlike external auditors that really are just looking to see if the financial statements are materially misstated, we would look for problems so that we can fix them. Okay, there's a problem here, well, okay, let's find something to fix that. Even if it's not material to financial statements, we want to do this right. And then we want to, and even though maybe it's saving $13,000 or something, okay, the external auditors don't care about $13,000, but the company actually does. So, we actually were a little more thorough. And I would go through the files, and I'd look for files that had a whole bunch of things that are stapled to it, and sticky notes and all that kind of stuff. Because invariably those had the problems, and those are the ones where you could actually find stuff that could help, that you could change systems and stuff like that. So it's not really any of those. It's sort of like looking for bad things. That's a method. Okay. Stratification. We talked a little bit about this, I think. All right. I don't know why I had this number should say this. I'm going to change it. Okay, so here's a partial list of 1,293 accounts, and here's the first 10. Okay, of these first 10 accounts, which of the accounts receivable will be most important for the auditor to verify? So
5, 6, 2,
more time?
5, 6, and 2.
Yeah, those are probably good ones to do. 5, 6, 2. These are all pretty high dollar relative to the other one. If number 3 is completely fictitious, who cares? It's $28. Whereas these other ones, these could be even material in just in themselves, depending on the size of the company. So, like the 77,000, if the total is 924,000, 77,000 is probably material in itself. Okay, so yeah, probably those would be good ones to look at. Because they're higher dollar value. So higher dollar value items are more interest to auditors. They have the possibility of being material or combining to be material. Which account is most likely fraud? kind of an odd question, but
If you were to choose just off of the number, possibly 5.
could be. The number that sticks out as very strange is number 6.
Oh, because it's an even amount.
Yeah, very rarely do. No, it is possible, and yeah, I mean, obviously it can happen. You know, but it's more unlikely. And then one of the weird things about fraud is a lot of times when people do cook the books, they do it by nice big round numbers for whatever reason. But it's very unusual to have transactions that come out to say 25,000 exactly. Can it happen? Yeah, it can happen. It's just unlikely. And truthfully, I mean, you know, it's just as likely as any of these other numbers to happen. If you talk about it, you know, statistically, but again, it's a very strange thing that it would hit on exactly 25,000 or 10,000 or whatever. And again, one of the weird things about fraud is that a lot of times when people commit fraud, they do it in big round numbers for whatever reason. Okay. So because we are more interested in these high dollar amount items, one of the things that they do, a lot of times they'll do what they call stratifying the sample. And what they'll do is they'll say, okay, so item values between, say, oops, let's try that again. Say $1 up to I don't know, 1,000. Percent audited, maybe, you know, we don't want to look at these, and in total they might be significant. But let's say that we'll do 3% of those. I'm just making the numbers up. Okay, and items from, let's say, 1,000. One through 10,000. We're a little more interested in these. These are bigger numbers. They are certainly they could cause a lot more misstatement than. I can't do that. You know, than these other ones. So maybe let's say, I don't know, I'm making this up. We'll do 20% of these. And accounts that are over 10,000. It's possibly take, you know, 100% of those. There's probably fewer of those, but those are the ones that are, if they are off, you know, they could be more likely to be material. So this is what they call stratifying a sample. You put it in different strata, and what you'll end up doing is doing basically 3 different populations. You break this up into 3 different populations. This one's actually not a sample. This is just checking 100%. These 2 will be samples. And you know, kind of piecing it together. So stratification is that the higher dollar value items are more interesting. They're more likely to make the books materially misstated. Okay, we'll go through the and we'll go through this, and then we'll stop after this. Okay, these shouldn't be too difficult. Okay, attribute sampling. By the way, any questions on the stratification? And by the way, when we're talking about the monetary unit sampling, one of the nice things is that it automatically does this, and anything that's over the interval is 100% sure to be picked. So the thing about monetary unit sampling, if it's an overstatement, is that it automatically does this for you. It doesn't in a fairly rational way. All right. Attributes. These are yes, no. Yes, no tests. Oops. Did a manager sign the purchase order? Eh. Either they did. Or they didn't. These are often pretty much exclusively done for testing of controls. So if there's a control that, for instance, the manager needs to sign off on the purchase order, that's a test of control. So your yes, no test, in sampling wordiness, this is called the binomial. And we I think I told you that maybe I didn't. It's a you use the normal distribution. I'll tell you this. I may have already told you this, but I'll bore you again with it. It comes down, it's a central limit theorem. This is a picture of the little dog that wouldn't come in, by the way. Her name's Polly. All right. So it's sort of like this. It's with the central limit theorem. You guys probably had this in your stats class. The central limit theorem is that all distributions when repeated will become normal distributions. So if whatever it is, if you have a distribution that looks like this, and you repeat it, it's going to eventually look like a normal distribution. So if you take this distribution and you do it 10 times, it's going to look like that. And that's what we run into with the binomial. It's the same thing. For instance, if you flip a coin, so you flip a coin once, you have a possibility of heads or tails. And the order doesn't matter. So, it's only flipped once. So this will be 50% and 50%. Flip the coin twice. It's a possibility it could be heads. and heads. Possibility could be tails and tails. It's possible the first one could be heads and the second one could be tails. And if we don't care about the order, or it could be tails and then heads. And so this would be so even when you get to the second flip, you can kind of see that this, is turning into a normal distribution, which is good because the normal distribution makes it a whole lot easier to do all the stats for it. So the central limit theorem is actually a very important one, and it kind of comes down to that you can actually use it for, instead of going through the binomial, which if you did that mathematically, it's a real pain in your stats class. You can estimate it using the normal distribution, and that's what we do because it's just easier to do it that way. So attribute sampling is binomial, but we'll use the normal distribution when we work out the numbers for it. Oops. All right, because this is no fun. All right, discovery sampling. Discovery sampling, it means that you can take a certain number of items, and if there is nothing found, you can make estimates as far as how much, whether there is an error or not. It could be for searching for anything, but a lot of times it's searching for fraud or something like that. So search for errors is a method that quantifies the likelihood of errors. And let me give you kind of an example. I'm making this number up, so this is not a. I think they're in the book. I could look it up in the book. But anyway, so for instance, if let's say you have a population of, let's make it a large one, 10,000 items. If you find no errors in 300 items, there might be they'll have some likelihood that there's any errors in the population. So they'll say, okay, no errors in 300 items. You might be, let's say, I'm just making this up absolutely. So discovery sampling is kind of when you're trying to discover something. And if you go through enough items without finding a problem, you can get to kind of high amounts of assuredness that there isn't a problem. So if you're looking for fraud, if you're looking for errors, if you're looking for whatever you're looking for in the sample, that's a discovery sample. And there's different ways of doing it. Classical sampling, we already did. I'm not going to go over it. So classical sampling is the mean per unit and all that kind of stuff. Okay, I'll put it here. Mean per unit, oops, ratio estimation. difference estimation. All right, so we did those. Monetary unit sampling, we did that too. Let's see, handout. Okay, dual purpose test is actually it could be used for almost any method. And usually it means you're testing for test of controls. Use same items. And substantive testing. And let me clean this up a little bit. Substantive testing is this. Substantive testing is for dollar amounts. And so this is like a monetary unit sampling. How much is it misstated by? And our classical sampling. These are the two main methods that we do for substantive testing. Not all of it, but a lot of it. Okay, so we could have test of controls. Let's make that green. And substantive testing. And let me give you an example. Test of controls. Oops. Let's say that we're going to pick 100 items. And substantive testing, let's say classical sampling, we're going to do mean per unit or something, or ratio. So let's say we'll do ratio distribution. Maybe we need to pick 500 items. Okay. All right. So ratio estimation, we need 500 items. Now, we could pick 100 items randomly for test controls and then pick another 500 items randomly and go pick those up for ratio estimation. However, what we could do is, try to be a little bit smarter and say, okay, these 100 items we chose for test controls, we're also going to use those for our ratio estimation. So that would be a dual purpose. So we pick those 100 items, those 100 items will be used for both. We're going to use it for our test of controls. to see, you know, did the manager sign the purchase order? And we're also gonna use it for ratio estimation. You know, we do pick our sample for ratio estimation, we're gonna use those same ones. So when we go to ratio estimation, instead of picking 500 items, we're gonna pick what, 400? Because 100 of those items will be used for both the dual test. Let's stop. And I gotta talk about something too. The chapter. Okay, so we'll stop there, page 3. I'm gonna send out the chapter 11 exam. It's due on, I think it's 3/24. So we going? Yeah. And just so you know, I'm gonna send it out tonight, but it's gonna be a little bit later tonight. Oops. Oops, that's not. I actually, I was gonna send out, there was one I was, but I'm gonna redo it. I looked at it and I don't like it. So anyway, I'm gonna send that, and I'm gonna kind of make up a different one, send out, but it should be tonight, but it might be a little bit later, might be closer to like 10 o'clock tonight. But I will send out the chapter 11 exam. Any questions? Okay, well, taking a long time tonight. Sorry, I thought we were gonna get out early. Anyway, all right. I will see you guys next week. Nothing to turn in except for the exam stuff I'm going to send out. So.
Okay, thank
All right,
you.
so much. All right, bye.
Great.
Thanks, Professor.
Okay, see ya.
Thank you, Professor.
Okay.